Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today we're talking about active versus passive business and what it means for you as a doctor.
All this other income is income that you're taking and being taxed on that you don't need to live your life. It's likely that you could become more efficient in the way that your assets are working.
And that is one of the most common things we hear. It's just that immediate wall of like, well, I'm a W-2 earner, so I already know there's nothing I can do to save on taxes. And we always have to have this pushback of like, yes, there is. Let us educate you. All right, Bob, this is something we're getting a lot of questions on. Many of our doctors coming to us are sophisticated enough to know that the U.S. tax code is written for business owners. And if they want to save big on taxes, they need to be in some sort of business entity. But that's where it stops and they're confused. How can I be a business owner if I'm a full-time doctor? And this idea of passive versus active has come up a lot, and I hear you educating our members on it. And so I thought it would be a great podcast episode to define what that means and how we help.
Mm-hmm. And I think it's, if I can interject real quickly, we were talking with a doctor this last week, and one of the comments that he made was, I talked to my CPA about this, and my CPA said, well, you're a high W-2 and you make a lot of money, so you're going to pay a lot of taxes. And my blood temperature immediately shot through the roof. It made me so angry because I'm like, how little creativity must one have to take someone's severe problem that you actually can help with? You actually can help with this, and just to dismiss it as if businesses just magically appear. Some fairy comes down from heaven and goes, "You're a business owner." That's not how it happens. And so it irritated me at such a high level. And he actually brought up this thing of, I don't have enough time to work hours to do this. And it made me feel like such frustration because these doctors who are such incredible servants to the people around them are not being served well themselves. And it just made me feel, I just wanted to just reach through the Zoom meeting and just give them a hug and say, you deserve more. So yeah. I'm looking forward to hearing your perspective on this, Bob.
And that is one of the most common things we hear. It's just that immediate wall of like, well, I'm a W-2 earner, so I already know there's nothing I can do to save on taxes. And we always have to have this pushback of like, yes, there is. Let us educate you. And that is also something that's so common is like, taxes are my biggest single expense. And a lot of these, they're angry on well, pardon my French, but I just pay a ton in taxes. And it's like, I feel your pain, but we can help you. So yes, I'd love to hear from Bob on this.
Yeah. Yeah. And I think it goes back to comments that we've made in other episodes of just the lack of effort that the tax industry puts into serving taxpayers. And man, I'm going to tell you, this is going to sound really weird. And if you're watching this and this is the first time you've seen anything about us, you're going to say this guy's nuts. But I think the tax code is absolutely brilliant. The tax returns are a phenomenal structure of how cash and income and money flows and business flows through one page to another, one schedule to another, to summarize on just 2 pages of the tax return. It's phenomenally brilliant.
And I love that you love that, Bob. It's like, I just, you genuinely, like you said, people are going to think it's weird. It is weird, but you have found the beauty in this system, and you found out how to make that system work for people. And one of the things that we do with potential members as they're going through discovery is actually looking at their tax returns. And for many of them, it's like the first time they've actually understood their tax return. We were going through one the other day with a couple, and you got to their charitable giving line item, and it said 0. And they said, that's not accurate. I'm not going to give specifics, but they're like, we give a lot. And their CPA literally just didn't even record it. And so it's just, I think understanding what's going on is helpful for you, certainly for our members, find that to be helpful, but just understanding not just like the numbers and where they go, but the beauty behind it.
Yeah. And I think there needs to be a foundational understanding as a business practice like us, serving taxpayers and helping them to understand why the rules are the way they are. Right. So we've said it multiple times that the tax code is written for business owners. We've used examples of video games. Right. If you want to get to level 2, you have to pass level 1. You can't just jump to level 2. So you have to look at the clues. You have to get the clues. You have to get that key and unlock the chest and get those rewards and open the door and go to level 2, and so on and so forth. And the way the tax code's written, and it didn't happen overnight. This is an evolution. This is why every time each law gets passed, they almost always have some kind of link to the tax code now. They giveth or taketh away, right? And at some point, almost every single law does that. And it's just crazy, but it's because of this evolution of cash flow. The government needs money. They need income. They need revenue, just like you and I do in our own personal lives. So it's a business structured as a business to create revenue, and we're the revenue generators. But if you want to know more about that, watch some of our other episodes.
So we're talking about active versus passive. Yes. First of all, like, what does that even mean? Like, if someone has a business, why, what does that mean from a technical perspective?
So let's talk about passive first, because that is the one thing that every single one of our physicians, when they're talking to their CPA or whoever's doing their taxes, says, "Oh, you can't write off that loss because it's passive income." Okay, and what does that mean? Just that. It's passive. It's an investment, right? We call it assets. And your assets create some sort of income based on the 3 stages of an asset and where they fall into. And that income, it creates a taxation. Okay. And so if you're personally, Dr. Joe, have $200,000 and you go buy a piece of property or real estate, whether you're putting on a tool belt or not, doesn't matter. That's passive, because you're spending all your other time generating and doing things as a doctor to generate your active income.
Mm-hmm.
Okay. Now, in real estate, I use that specifically because the government has created specific rules to a real estate professional, and the details and the rules of how to qualify as a real estate professional to get losses in real estate. Why did they do that? Because there's so many people that would put money into real estate, take the passive losses to offset active income taxes, and the IRS is like, time out. Not because people were doing it, is because people were promoting it inappropriately and inaccurately. But it was based on how the tax code is written at that time. So it was accurate, but it wasn't the motivation of what the government was trying to communicate to us. So what they do, they change the rules, just like in the NFL. Something happens, they change the rules. In basketball, NBA, if something happens, they change the rules. The government has that ability to do that as well, and they change the rules. Okay? But that passive is an investment. And if it's in your name, Dr. Joe's name, you've made it purposeful that it's a passive income. So one of the things we talk about, and this may be getting a little nerdy, but this is important, because the structure of that investment, that contribution, is the first stage, and that's what you're dictating if it's going to be active or passive. You've given that a purpose of passive investment, passive income. Okay. Now, you don't lose the losses. You can't actively take those losses today. Those losses get put in a bucket later on and calculated. Every year there's a loss. They get put in this bucket. And when that asset gets sold, they take these losses and offset it, and they still use it. So it's not completely disappear or gone, at least currently, right? Could easily be a potential change in the rules down the road, right? So that's what really passive is, something that you're not spending a bunch of time doing. I don't want to say it's a hobby, it's an investment, right? You got money and you put it in there. Plain
But
and simple.
they would call it a hobby, right?
They would call it a hobby, and here's why. It's a good point. Is the Schedule C and the Schedule E, page 1. Okay? Both business schedules. But Schedule C, where a lot of people say, well, put your real estate in an LLC. That doesn't mean you get a tax benefit. They're doing that for liability protection. Okay? So Schedule C, though, is for self-employed, whether you're an LLC or not. You could be a single member LLC. So if it's just Dr. Joe, right, at LLC, well, and it's only you as a member, then it's a single member, so it goes on Schedule C. That's self-employment, basically.
Mm-hmm.
Number one audited schedule on the entire tax return.
And we've seen people with millions of income on Schedule C.
Yes. In their active business as a physician.
So is this an easy tell, Bob, for someone if a doctor's watching this and they happen to they pause this episode right now and they go get their tax return, their most recent tax return, and they pull up Schedule C and they see all this activity on Schedule C, is that an easy tell to say, I need terra firma?
I love that you asked that. Yes. Here are the schedules you'll need to look at. And these are the schedules where you have your personal investments. Okay. Again, we call them assets. You have your personal assets, and they're calculated on Schedule B. It's interest and dividends. So this is going to be your savings accounts, your CDs, your brokerage account, any type of liquid stocks, bonds, mutual fund type earnings of interest and dividends is going to be on Schedule B. If you have anything there that's creating income, it's personal. It's passive. Okay. If you have a Schedule C, anything there, self-employment. Bottom line. And the reason why that's the number one scheduled, audited schedule is because a lot of people who do their own taxes don't know how to calculate and account for. They're not doing bookkeeping. A lot of times they don't have a separate bank account to separate that.
Right.
So when the IRS audits that, they're just like, we just want to make sure that you actually have a separate bank account, that what you're saying as expenses and mileage or dinners, entertainment, that it's accurate, right? Do you have evidence or proof, documentation showing that that's right? Right? They're not challenging. They're not saying you're a liar. But any business partner, I use this as an example as spouses, right? If you go out and hang out and you don't tell your wife that you're out with the guys, and you come home and she's like, Joe, where have you been? You're like, oh, I was out with the guys. Oh, well, you didn't tell me. Yeah. How's that going to go over? And then when she says, well, who was there? Oh, just the guys from, back in the day. Oh, well, what'd you guys talk about? Just stuff. That's essentially the equivalent of what people do from a tax return perspective. That's not going to go well. Or I don't know, maybe, Joe, will it go well?
Well, it would be fine. That analogy doesn't hold true in my world, but I understand the sentiment. just out on your own willy-nilly, no accountability, that's where there's going to be a problem.
It's an issue.
Right.
In any relationship, it's an issue. Period. And so, because you just didn't communicate. That's all it is, just a communication. Whether you were right or wrong, it's just I care about you, I'm just going to give you a heads up. So, what other schedule? Schedule D. Capital gains. That's because you sold a personal asset. Okay? And the last one is Schedule E, page 1. Schedule E, page 1 is your personally held real estate. Okay? Looks like Schedule E, page 2. The only difference is that it has for your rental income and all that fun stuff. Okay? Page 2 of the Schedule E is where we want to be. Partnerships and S corps. Okay? Now, we won't talk about C corps and all that kind of stuff, but that's really the major one. So if you're sitting there looking at your tax return, you're like, oh, I got all those. And all those will be on the first page, the first 8 lines.
Summarized. So
right. You don't even have to go through all these pages and figure that out. Just go to your first page and look at the first 8 lines. And you're like, oh, okay. That's personal taxable income. Okay.
And it goes to like answer the question for yourself. Am I making more money than I need from my job, as a W-2 doctor or, whatever it might be? Am I making more money than I need to live the life that I want? If so, all this other income is income that you're taking and being taxed on that you don't need to live your life. It's likely that you could become more efficient in the way that your assets are working. So when we're talking about active and passive, so Bob, what you're saying is the passive losses are not necessarily lost forever. You can recapture those at some point. But when it comes to paying taxes today, it does have an impact. And so what's the deal with active, and how could I as a doctor have active income outside of my job? I'm already working 60 hours a week, 80 hours a week. What's that like?
So language and semantics, words are everything with the tax code, the legal system, and insurance.
I would just say in general, I always say words matter. There's a difference between peeing in the pool and peeing into the pool. Those are two different scenarios.
Yeah. Either way, you don't want to be in the pool. Yeah. Either way, don't be in the pool. When Joe says, hey, you want to go swimming? Just say, no, I'm good. I'm going to hang out in the jacuzzi. So active, there's specific language in that IRS communicates to us. And one of them, the word or the term is material participant or material participation. Okay. And what they mean by that is they give us 3 criteria of how to define it. You don't need to hit all 3. You need to hit one of the 3 to determine the activity of your income being active income. Now, here's where a lot of CPAs will say, well, you make $1 million as a doctor. Okay. Is that 80 hours a week? Is that 15 hours a week? I don't know. Right. Now, if you're W-2, obviously there's payroll and all that kind of stuff, and it's based on a full-time hour schedule. But are you full-time? Either way, it doesn't matter. You're a doctor, and that's what you're actively doing, right? And so in the employment W-2 world, we track hours and hourly wages, and that's what the 941s and all that fun stuff on the specific IRS forms that track that. Okay. Now, when you have other businesses, and that's because it meets the first, and I'm going to read off of what it says. A taxpayer works 500 or more hours in the business during the year. Okay. So that's if you have a business and you're
Which would be roughly a quarter time. Like that would be roughly, 10 hours a week, something like that.
Yeah. Let's do 500 divided by 52 weeks. That's 9.6 hours a week. So, I mean, that is literally part-time.
Right.
And it says 500 or more. So if you're making $1 million working 40 hours and you're like, yeah, well, maybe I just want to cut down to 20 hours and I make $500,000. I'm still comfortable with our family's lifestyle. You're still active, right? The other one is the taxpayer does the majority of the work in the business. Notice these aren't like extremely specific, but they give us an idea of what the motivation and the purpose of that material participation means, right? The last one is a taxpayer works more than 100 hours, which is 1.9 hours a week. The taxpayer works more than 100 hours in the business during the year, and no other staff works more hours than the taxpayer. Okay.
Well, and this is, think about we see these people all the time, influencers on TikTok and Instagram and Facebook, and they're making $1 million a day, doing selling their course. They're not working those hours. They have a system and a business that's generating income, and they are the key driver of that. That doesn't mean that's passive income. That's a real business that they are operating that's generating real revenue.
Mm-hmm. Now, if they work less than 500 hours, or what was it, 9.6 a week, and they have staff that works more than them,
Mm-hmm.
It's passive.
Hmm.
So the IRS also has something called proof of participation. And this is documentation, right? So like I said, on the 500 plus hours as a full-time employee, you W-2, you use a payroll service, you have certain tax forms that are required to be submitted as a business owner, right? And we get a W-2, right? And we use that W-2 on our taxes, and we get 1099, which is non-W-2 income, right? K-1s, right? There's a whole bunch of all those numbers are indications of IRS forms indicating the type of income that we earn from that particular asset and how the structure of that asset is. Okay. So the last one that is 100 hours or more and no other. So if you decided to start a business and you said, yep, I'm going to do it. I'm going to create an S corporation and I'm going to create this S corporation. And again, we're not giving advice here, right? This is all educational information. These are all hypotheticals. We don't know you. Just because you're watching us doesn't mean that we magically know who you are, right? Maybe that's next year's technology, but it isn't right now, right? It's crazy. Just because we said it, now somebody's going to do it. So you decide to do that. You set up an S corp just because that's what you heard somebody say to do, and so you set up an S corp, and you decide to use money in that S. You put money in that S corp, which is the contribution, right? In that business world, it's called cost basis from an accounting perspective, and you decide to put that money into an investment, another business, and you spend about 2 hours a week kind of managing it, talking to the staff, talking to whoever, or maybe there is no staff. Maybe all of a sudden you have 5 or 6 businesses and you have staffly meetings that you do on a weekly basis to check and see how everything's going. Or maybe it's an asset or a business that doesn't require other staff to be involved. Because remember, this one is 100 hours with nobody else working more hours than the taxpayer. Could that be deemed as active? If it meets that criteria, how do I prove it? Well, the IRS has language on what that means on the documentation. So when doctors come to us, every meeting we have is a documented meeting because they hire us as their advisory team, as their professional team. All of our people involved in our team are working on behalf of them. They're the boss of their business. They don't compensate us in their business, right? We're not only employed, we're not a 1099 employee of their business, right? And we have conversations. We document all those conversations, every single conversation, as proof of participation. Does that add up to 100 hours? I don't know. I would say it does. Now, does that mean that you have to set a timer 1.9 hours a week? No. That we just took 100 hours. The IRS doesn't specifically say. They just give you a round number. So you could literally, based on your practice, the first part of the year, you don't do any doctoring and you do all your business stuff in that, and you get your 100 hours in that first part of the year. You've made it. Just, you got to show proof of participation. Prove that that's what you did. So all we're talking about is evidence, documentation. That's everything. As a doctor, you have to document everything already for your patients. Shouldn't you be documenting? How do you document? Well, that's the thing. A lot of people don't know how to do that. And so that's why we do that with our members on behalf of our members, so they can have a service that helps them do the documentation, because they're not an expert in this. You're not an expert in this as a doctor watching this. So now it becomes active. And so if there are losses in that active business, then those losses actually can be used to offset other active income losses, just based on how the IRS communicates to us. all the details and all that underlying stuff that we haven't talked about, that's really what allows the proof of participation, allows somebody to be able to do this. But my point earlier is, this is brilliant. The IRS tells us what the rules are. You as a doctor know the rules of doctoring. They're there as a guideline. And if you can prove why you're going to do something that may not be exact guideline or rule in doctoring, but you can prove that it's beneficial among all the different regulatory people that are overseeing you, and you're going to have to document that, and that health of that person becomes better because of that's what you've done. Done.
And that's what we do for our members. I think that's the bottom line, is people need to understand that there is a different way of doing things. This happens in your world all the time, Doc, right? People come in for a second opinion. Hey, this other doctor told me this, and you look at their scenario, maybe you agree, maybe you totally disagree. And what we find most of the time is we disagree with how your current team is serving you, and there's just a better way to do it. And it's not that they don't care about you. It's not that they're a bad person. They just don't know. And what I would say is they don't care to know. They have a fine practice doing things the way that they've always done it. So I just think, again, my blood starts boiling because I know how hard you work, doctor. I know what you've sacrificed and what you've given up to get into the position that you're in. And it behooves you to look at things a little bit differently. As you've grown in your income, as you've grown in your stature, as you've grown in your career, it's time to look at, is my current team the right team to serve me? If you continue to get those same responses like, well, this is just all you can do, congratulate. It's one of the most common ones, right? Congratulations, you get to pay a lot in taxes because you make a lot of money. Man, that's just like nothing should irritate you more than hearing that statement. So if you find yourself bringing these things, these ideas to your CPA or to your tax person, and they're just, you probably have this thought like, do you work for the IRS or do you work for me? If that goes through your head, you need to reach out, have a conversation with us. We can let you know in a very short period of time how much you might be overpaying in federal income taxes. Aaron, you're having these meetings all day, every day with people. What percentage of the time would you say someone is in a position where they really need our help? Like we can do something for them, like out of 10 conversations.
9.8 of them.
So the vast majority. I mean, the bottom line is like, reach out, let us help you. How can they get in touch with us, or what's the best way to get that information?
We are all the places. I would suggest starting with our website, terrafirmaconsultant.com. All the info is there. We've got case studies. We've got frequently asked questions. You can do a lot of research on us before you even reach out. But then, get started with your cash flow recovery conversation. Like Joe said, we can tell you how much you're overpaying, and people are usually shocked by that number. We are on all the socials. You can comment below. We would love to talk to you.
Awesome. Well, let today be the last day where you're operating without this plan, without a team in place who's as excited and nerdy about the tax code as Bob is. Make a decision to do things differently. Let's make sure that you're maximizing the way that your income is coming to you, whether it's active or passive, setting you up in a position to be able to maximize that for your benefit so that you can grow your wealth like the wealthy do. So until next time, go be a wealth map.